ExamPrep.School. Vermont Producers Life Insurance Exam, exam code SERIES 14-25. There are 4 practice exams in this series. This video covers Practice Exam 1. The first 20 questions are free. In this video, we will be covering the following major categories for Practice Exam 1. Annuities. Federal tax for life and annuities. General insurance. Insurance regulation. Life insurance basics. Life insurance policies. Policy provisions, options, and riders. Qualified plans. Let's walk through the format. I'll read each question and its choices. Let's get started. Question 1. Under 8 VSA Section 4800, which of the following is not required to accompany a resident insurance producer license application in Vermont? A. Letter of reference from the applicant's current insurer. B. Certificate of completion of an approved pre-licensing education course. C. Fingerprint submission for a criminal background check. D. Payment of the application processing fee. A countdown circle appears in the top right. Once it completes, the answer is revealed. You can pause at any time if you'd like longer to think. If you'd like additional practice covering more topics, see the description for our book. The correct answer is A. The correct answer is that a letter of reference from the current insurer is not required. Under 8 VSA Section 4800, applicants must submit proof of pre-licensing education, fingerprints for a background check, and the required fee, but no letter of reference is mandated. Reason B is not correct. A certificate of completion of pre-licensing education is explicitly required to demonstrate that the applicant has met the education prerequisites. Reason C is not correct. Submission of fingerprints is mandated to allow the department to conduct a criminal history background check. Reason D is not correct. Payment of the application fee is required at the time of submission in order to process the application. Question 2. Under Vermont's non-resident producer reciprocity rules, an applicant is eligible to receive a Vermont non-resident insurance producer license if the individual A. holds a valid resident producer license in their home state. B. Completes Vermont's pre-licensing education requirement. C. Maintains continuous residency in Vermont for at least 30 days. D. Submits a letter of good standing from every state where licensed. The correct answer is A. The correct answer is that the applicant must hold a valid resident producer license in their home state. Under Vermont reciprocity, non-resident applicants are licensed if they are in good standing and licensed in a state that reciprocates with Vermont. Reason B is not correct. Non-resident applicants under reciprocity are exempt from Vermont's pre-licensing education requirement. Reason C is not correct. Non-resident reciprocity does not require establishing residency in Vermont. Reason D is not correct. A letter of good standing from every licensing jurisdiction is not needed. Having a valid home state license suffices under reciprocity. Question 3. Which situation qualifies an individual for a temporary insurance producer license in Vermont? A. The permanent licensee has died or become mentally disabled. B. The individual has passed the licensing examination but is awaiting final processing. C. The individual has just been appointed to handle new business for a domestic insurer. D. The individual has a disciplinary hearing pending before the state regulator. The correct answer is A. The correct answer is that temporary licenses are issued when the permanent licensee dies or becomes mentally or physically disabled. Other circumstances do not meet the statutory conditions for a temporary license in Vermont. Reason B is not correct. Passing the exam alone does not trigger eligibility for a temporary license without death or disability of the current licensee. Reason C is not correct. Appointment to write new business does not qualify an applicant for a temporary license. Reason D is not correct. A pending disciplinary hearing disqualifies rather than qualifies an applicant for a temporary license. Question 4. A life insurance producer in Vermont must complete 24 continuing education hours every 2 years, including at least 3 hours in ethics and 3 hours in long-term care. The current compliance cycle ends December 31st, 2023. As of October 1st, 2023, the producer has completed 8 hours of approved CE, comprising 1 hour of ethics and 2 hours of long-term care. Which statement best describes the additional CE requirements the producer must fulfill by cycle end? A. Complete 16 additional hours, including at least 2 hours of ethics and 1 hour of long-term care. B. Complete 18 additional hours, including at least 2 hours of ethics and 1 hour of long-term care. C. Complete 16 additional hours, including at least 2 hours of ethics and 3 hours of long-term care. D. Complete 18 additional hours, including at least 3 hours of ethics and 1 hour of long-term care. The correct answer is A. The correct answer is to reach the 24-hour requirement by adding 16 hours and to satisfy the sub-requirements by adding 2 ethics hours to total 3 and 1 long-term care hour to total 3. Reason B is not correct. This overstates the total additional hours by 2, since only 16 more hours are needed to reach 24. Reason C is not correct. This incorrectly requires 3 more long-term care hours exceeding the 3-hour total requirement. Reason D is not correct. This overstates both the total hours and the ethics hours needed to meet the cycle requirements. Question 5. Under Vermont insurance statutes, what is the minimum number of days written notice the Commissioner of the Department of Financial Regulation must provide to an insurer before commencing a market conduct examination? A. 5 days. B. 10 days. C. 15 days. D. 30 days. The correct answer is B. The correct answer is 10 days because Vermont law requires at least 10 days written notice before a market conduct examination may begin. Reason A is not correct. A 5-day notice period is too short and does not meet the statutory minimum. Reason C is not correct. A 15-day notice exceeds the minimum requirement, but is not the specified period. Reason D is not correct. A 30-day notice is longer than required under Vermont statutes. Question 6. Under Vermont insurance regulation, after issuing a cease and desist order, if the respondent does not request a hearing, when does the order become final and enforceable? A. Immediately upon delivery. B. 10 days after delivery. C. 30 days after delivery. D. 20 days after delivery. The correct answer is D. The correct answer is 20 days after delivery because Vermont law specifies that a cease and desist order becomes final if no hearing is requested within 20 days. Reason A is not correct. Immediate finality is incorrect. A waiting period is required. Reason B is not correct. A 10-day period is shorter than the statutory requirement. Reason C is not correct. A 30-day period exceeds the time frame set by statute. Question 7. Under rules of the Vermont Department of Financial Regulation, what is the minimum retention period for producers' records of insurance business transactions? A. 3 years. B. 5 years. C. 7 years. D. 10 years. The correct answer is B. The correct answer is 5 years because producers are required to keep transaction records for at least 5 years under Vermont regulations. Reason A is not correct. A 3-year period is shorter than the regulated minimum. Reason C is not correct. A 7-year period exceeds the minimum requirement. Reason D is not correct. A 10-year retention is longer than mandated by Vermont rules. Question 8. A Vermont licensed producer prepares a print brochure to promote ABC Insurers' fixed dividend whole life policy. The brochure boldly declares, earn a guaranteed 4% annual dividend with ABC Insurers' whole life plan. Under Vermont advertising regulations, which of the following must accompany this claim to ensure compliance? A. A disclosure that past dividend rates do not predict future dividend levels. B. A statement that the policy may lapse if premiums are not paid on time. C. A clear declaration that dividends are not guaranteed and depend on company financial performance. D. A notice that policy loans will accrue interest at the current market rate. The correct answer is C. The correct answer is a clear declaration that dividends are not guaranteed and depend on company financial performance because Vermont regulations require any advertised dividend claims to be accompanied by a non-guaranteed disclaimer to prevent misrepresentation. Reason A is not correct. This disclosure addresses past performance, but does not explicitly state that future dividends are not guaranteed, which is required by Vermont rules. Reason B is not correct. While timely payment is important, this statement does not address the non-guarantee of dividends in an advertisement. Reason D is not correct. Information about loan interest rates is unrelated to the required disclaimer on advertised dividend guarantees. Question 9. Under the Fair Credit Reporting Act, when an insurer takes an adverse action based in whole or in part on information in a consumer's credit report, within what time frame must the insurer provide the required adverse action notice to the consumer? A. Within 3 business days after taking the adverse action. B. Within 5 business days after taking the adverse action. C. Within 10 calendar days after taking the adverse action. D. Within 30 calendar days after taking the adverse action. The correct answer is D. The Fair Credit Reporting Act requires the consumer receive the adverse action notice within 30 calendar days after the action is taken, ensuring they have timely information to contest or correct the report. Reason A is not correct. This time frame is too short. The Act allows up to 30 calendar days, not 3 business days. Reason B is not correct. 5 business days underestimates the allowable period. The Act requires notice within 30 calendar days. Reason C is not correct. 10 calendar days is shorter than the statutory maximum. The required period is 30 days. Question 10. An insurer is onboarding a new corporate policyholder whose beneficial owners include individuals from jurisdictions designated as high risk under the USA Patriot Act anti-money laundering rules. Before issuing the policy, which screening procedure must the insurer perform to comply with these requirements? A. Screen the beneficial owners against the Office of Foreign Assets Control's specially designated nationals list. B. Submit the policy to FinCEN for an external audit. C. Verify the policy premium deposit with a federally insured bank. D. Obtain trust receipts from each beneficial owner. The correct answer is A. The insurer must screen beneficial owners against the OFAC specially designated nationals list as part of the Customer Identification Program obligations under the USA Patriot Act anti-money laundering provisions. Reason B is not correct. External audits by FinCEN are not a required screening step for initial customer identification under anti-money laundering rules. Reason C is not correct. Verifying premium deposits with a bank does not satisfy the requirement to check against prohibited party lists. Reason D is not correct. Trust receipts are related to collateral documentation and not part of the anti-money laundering screening procedures. Question 11. Under Vermont insurance regulations, twisting is defined as making false or misleading statements about an existing policy's terms, benefits, dividends, or non-forfeiture values to induce an insured to lapse, forfeit, surrender, or replace that policy. Which of the following actions exemplifies twisting? A. Misrepresenting the insurer's financial strength in recruitment materials. B. Offering to waive a portion of the first-year premium to attract a new prospect. C. Telling a policyholder that their current policy has no cash surrender value when it actually does. D. Advertising reduced commission rates to clients on new policies. The correct answer is C. The correct answer is the one that involves making a false statement about an existing policy's cash surrender value to encourage replacement, which directly matches the statutory definition of twisting under Vermont law. Reason A is not correct. Misrepresenting an insurer's financial strength in recruitment materials is a wrongful act, but does not involve inducing replacement of an existing policy. Reason B is not correct. Offering premium waivers to new prospects is a form of rebating, not misrepresenting an existing policy to induce its replacement. Reason D is not correct. Advertising lower commissions on new policies is a marketing incentive and not a misrepresentation about an existing policy's terms to effect replacement. Question 12. A producer advises a policy owner to replace an in-force life insurance policy twice within a year without improving coverage but incurring extra fees to generate additional commissions. This conduct exemplifies which prohibited practice? A. Twisting by policy misrepresentation. B. Misrepresentation of policy benefits. C. Rebating commissions to induce purchase. D. Churning through repeated policy replacement. The correct answer is D. Churning involves repeatedly replacing an in-force policy to generate commissions without any net advantage to the policy owner, which is prohibited under state regulations. Reason A is not correct. Twisting requires misrepresenting policy features to induce replacement, whereas this scenario focuses on serial replacements solely for commission. Reason B is not correct. Misrepresentation involves false statements about the policy's terms, not repetitive replacements for agent profit without benefit. Reason C is not correct. Rebating refers to giving part of the commission or premium back to the insured, which did not occur in this situation. Question 13. Under Vermont Statute Section 48.04, which of the following actions constitutes a valid ground for suspension of an insurance producer's license? A. Misleading an applicant about dividend projections. B. Neglecting to file a notice of address change. C. Fraudulent conversion of client premium payments. D. Use of an unapproved insurance policy form. The correct answer is C. This option describes fraudulently redirecting premiums, which Section 4804 explicitly lists as a ground for license suspension. Reason A is not correct. Misleading applicants about dividend projections is improper but not specified as a suspension ground under Section 4804. Reason B is not correct. Failing to notify an address change violates administrative rules but does not trigger suspension under Section 4804. Reason D is not correct. Using an unapproved form is a regulatory violation correctable by amendment, not a statutory basis for suspension under Section 4804. Question 14. According to Vermont's Notice and Hearing Procedures for Insurance Disciplinary Actions, what is the minimum period of written notice required to be given before conducting a license suspension hearing? A. 5 days. B. 10 days. C. 30 days. D. 45 days. The correct answer is B. Vermont regulations mandate that an insurance producer receive at least 10 days written notice prior to any disciplinary hearing. Reason A is not correct. A 5-day notice period is shorter than the statutory minimum and thus insufficient for due process. Reason C is not correct. A 30-day notice exceeds the minimum requirement but does not represent the statutory minimum period. Reason D is not correct. A 45-day notice exceeds the required period and is not the designated minimum notice period. Question 15. Within risk management frameworks, which feature exclusively characterizes pure risk as opposed to speculative risk? A. Events involve outcomes predictable solely by economic market fluctuations rather than mortality data. B. The scenario involves voluntary business decisions intended to produce profit or avert loss. C. The exposure presents only the chance of financial loss or no loss, with no opportunity for gain. D. Risk mitigation is achieved through dividend adjustments on variable policies. The correct answer is C. The correct answer accurately describes how pure risk situations permit only loss or no loss, whereas speculative risk involves potential gain or loss. Reason A is not correct. Both pure and speculative risks may be analyzed statistically. This wording misattributes exclusivity to pure risk. Reason B is not correct. Voluntary profit-seeking decisions describe speculative risk, not pure risk. Reason D is not correct. Dividend adjustments pertain to policy features and do not define the nature of pure risk exposures. Question 16. Which function does the law of large numbers primarily serve in the context of life insurance operations? A. Enabling waivers of insurable interest requirements for all insureds. B. Ensuring guaranteed dividend scales remain constant over policy terms. C. Stabilizing premium adequacy by predicting mortality outcomes across homogeneous risk pools. D. Maximizing insurer profits through selective underwriting stratification. The correct answer is C. This option is correct because it describes how statistical probabilities across large populations are used to stabilize expected losses and set accurate premiums. Reason A is not correct. The law of large numbers does not affect legal insurable interest requirements. Reason B is not correct. Dividend scales depend on surplus and investment performance, not directly on statistical pooling. Reason D is not correct. Underwriting selection affects risk exposure but does not represent the statistical pooling function of the law of large numbers. Question 17. An applicant for a personal life insurance policy has a family history of early onset heart disease and declines the insurer's request for additional medical tests. To mitigate adverse selection, how is the underwriter most likely to respond? A. Offer the policy at standard rates without modification. B. Decline the application due to incomplete information. C. Approve the application with a higher premium rating. D. Approve at standard rates but require periodic medical exams. The correct answer is C. The correct answer is that the underwriter will attach a higher premium rating to offset the increased risk from incomplete medical information. Adverse selection arises when higher risk applicants self-select, so insurers charge a rating to neutralize potential losses. Reason A is not correct. Offering standard rates ignores the elevated risk from unverified health information. Reason B is not correct. Declining the application is excessive. Insurers typically rate rather than reject for missing tests. Reason D is not correct. Periodic exams don't immediately adjust for current unknown risk, so a rating is preferred. Question 18. A small manufacturing firm decides to self-insure all equipment losses under $10,000 and completely avoid operations in regions prone to hurricane damage. Which two risk management methods are being employed? A. Risk retention and risk transfer. B. Risk retention and risk avoidance. C. Risk reduction and risk transfer. D. Risk sharing and risk retention. The correct answer is B. The correct answer is retention for self-insuring small losses and avoidance for eliminating operations in hurricane zones. Retention involves keeping risk, while avoidance involves eliminating exposure entirely. Reason A is not correct. Risk transfer would involve buying insurance which isn't used for sub-$10,000 losses. Reason C is not correct. Risk reduction seeks to lessen risk, whereas avoidance eliminates it and retention keeps it. Reason D is not correct. Risk sharing involves partnerships or pooling, which isn't described here. Question 19. Within a stock insurer's capital structure, funds received from shareholders in excess of the stock's par value are reported as which of the following? A. Retained earnings. B. Paid-in surplus. C. Policyholder dividends. D. Loss reserves. The correct answer is B. The correct answer is paid-in surplus because it represents capital received from shareholders above par value, distinct from earned profits or liabilities. Reason A is not correct. Retained earnings reflect accumulated net income, not capital contributions above par value. Reason C is not correct. Policyholder dividends are distributions to policyholders, not funds paid by shareholders. Reason D is not correct. Loss reserves are liabilities set aside for future claims, unrelated to shareholder contributions. Question 20. Which of the following rights is exclusive to policy owners of a mutual insurer? A. Receive guaranteed annual dividends. B. Sell voting shares on the open market. C. Vote for the board of directors. D. Access excess surplus funds on demand. The correct answer is C. The correct answer is the right to vote for the board of directors, as mutual insurer policy owners collectively govern the company rather than owning shares traded externally. Reason A is not correct. Dividends in mutual insurers are not guaranteed and depend on financial performance. Reason B is not correct. Mutual insurer policy owners cannot sell voting shares because no tradable stock exists. Reason D is not correct. Policy owners cannot unilaterally withdraw surplus funds. Distributions depend on board approval. Enjoyed this practice test? Tap like, hit subscribe, and share it with a classmate. Got a question we should tweak? Comment below, we read them all. Find full practice exam books in the description or at ExamPrep.School.